All right. So we'll show you, for those of you that are on this call, just a quick example, and then you can, on this page, I'm sure there will be a form on this page that you can just fill that out and give us a little bit of an idea of what your current scenario is, and then we can just run a specified report for you because everybody's going to have their own parameters depending on age and the amount you're contributing and the state that you're in, all this good stuff. But how does this policy pay, in this scenario, $39,977 tax free every single year to somebody? This is really kind of the main question of people are saying, well, how do I participate? How do I get this going? And we'll just kind of hit the key points and just make it really simple on here. So this is just one policy. Every state has different companies and regulations and different plans that you can go through. So first things first, aside from the income, we'll just hit each piece individually. So this policy has what I think are the most important things. But first one's going to be critical illness. So when you're contributing into, a 401k, a 403b, a 457 IRA, SEP IRA, whatever you're doing, that money is there. And then the number one cause in America of drowning retirement accounts is illnesses. I mean, when these things happen, the funds are gone a lot of times almost overnight, which is pretty sad. But critical illness coverage pays out a specified amount, in this case, $233,000 to this individual. And by the way, this is for a 30-year-old female in Arizona. As I said, everybody's going to have a completely different report ran for them. But in this case, if she were diagnosed with critical illnesses like cancer, heart attack, or stroke, then she would be paid out $233,594 tax free. This is just goes to her tax free. It's not draining her accounts. It's not minimizing her cash value in her cash or any in her cash value accounts or anything. It's just an added bonus. Now, chronic illnesses are things. I'll zoom in so you all can see here. Chronic illnesses are things that you'll never get rid of, like Lou Gehrig's disease, dementia, Alzheimer's, right? Things that you would typically have a long-term care policy for, which if you've ever priced one out is really, really expensive. But chronic illnesses are huge. Those are, I mean, again, we're in America. $90,000 is what she would be paid out if she were diagnosed with any kind of critical illness. So that's important. Terminal illness as well. Terminal illness pays out $363,000 if she's ever deemed terminally ill. So that means, a doctor or physician tells you, I'm sorry, but you only have 12 months or less to live. At that point, they just go ahead and hand over $363,000. There's all these other additional riders that you can add in here. Accidental death coverage, child term rider, you can cover your spouse. There's other things, and again, it depends on what state and what plan you're in. But regardless, that's going to be the first point there. Now let's get to the cash value accumulation, college saving aspect of this, so on and so forth. I know there's a lot of numbers on here, and I'm trying to zoom through these so nobody really pays attention to the things that um, might confuse you and that don't typically matter all that much. So let me run you through her scenario. So she is 31 years of age. I'm sorry, she's 30 years of age. So after year one, this is where it starts. Okay. She is contributing $300 a month or $360. I'm sorry, $3,600 a year. Now you can start typically. The lowest you want to start is $100 a month, but you can, depending on the state, you can go up to whatever the heck you want. You can do 100, 200, 300, 400, 500, 600. There's people doing 650, 70. It doesn't really 650, 700. Doesn't really matter what you want to do. We'll just run the report to whatever you're thinking. But what we're going to look at is, let's just go out 20 years, let's say. Okay. So now she's 50 years of age. So she's been contributing to this plan for 20 years. And keep in mind, if she's ever had a heart attack, cancer, or stroke, which, one out of every three Females in America are going to develop some kind of cancer. 1 out of every other male, so 1 out of 2 males is at 50% now is going to develop some kind of cancer. So if she were to get cancer, heart attack, or stroke at all, she's protected. Also, at this point in time, her projected cash value is about $110,000 in this account. And this is what this column is here, okay? The account value. And she can borrow from this money at any point in time without penalty, which again is huge. If you're contributing into a 401k, a 457, any of these tax deferred accounts, then you know that if you're under the age of 59 and a half, you can't access that money without getting hit with that 10% penalty from the IRS, right? So this she doesn't have to worry about. Now, let's continue down to, let's say, age 65. When is she going to retire? Sorry, I'm trying to zoom in so you guys can see this, but we have her at age 65. She is going to, that's going to be her last year working, and now she's retiring. So at 66, she's not putting in any more money. She's going to take out this tax-free dollar amount for the rest of her life, $39,977. She has a job where she does not have a pension, so this is absolutely crucial. But definitely, you know, teachers, hospital workers, you know, depending if you're a police force, firefighter, they do have pensions, and they're going to have completely different plans. But yeah, either way, supplemental coverage there. And the death benefit is in this very far column. So I want us to notice that there's $500,000 of death benefit on this plan the entire time as well. And this Amanda, the report that we're looking at here, she has 3 kids. So if she were to pass away at any point in time, then this $508,000 would pay out to her children tax-free. And that's at any point in time. So even if we go to year, let's say when she's 41, that's 11 years in, she has about $37,000 of cash value projected. Well, guess what? If she passed away, then her children would get $500,000 tax-free. And you know, you can really use this as the most flexible account because you can change these contributions at any point in time. Most people like to layer it, you know, kind of run the report of, hey, what if I increase my contribution by $100 every 10 years, whatever you want to do. But if you ever need a new refrigerator, if you ever need to pay for a wedding, if you ever, you know, college savings, emergency fund, anything that you need, pull it from here versus your retirement account so you don't get hit with that 10% deduction. I'm sorry, that 10% penalty, as well as if you're putting into a 401k, which is a tax deferred account, you have to keep in mind that those accounts haven't been taxed yet. So not only are you going to have to pay the 10% penalty, but you're also going to have to pay the taxes on the money that you're taking out. In this case, if you want to, you know, pull out 20K at year, let's say 41, when she has about 37,000 in here, she needs to pull out, let's say, I don't know, she's putting a down payment on a car for her daughter. She's ready to drive now. She pulls out 7K from here. There's no tax implication on that money. There's no penalty. So it's flexible. So you have the income, which is, you know, basically everybody's number one thing here, the tax-free income for life. You have the death benefit that decreases once you stop contributing to it. But I mean, even if we go down to age 90, she's 90 years old now, she still has, you know, 97K in death benefit. But the whole way through, she's, you know, covered her entire working years for $500,000. And then you also have what we call the paycheck protection with these 3 riders. And I mean, this really saves your butt when it comes to, if you know anybody, any of you on this call, there's about 100 and something of you on this call. If you know it, I'm sure there's tons of people on here that's known somebody cancer, heart attack, or stroke. You know how devastating financially that is. And this really protects you from draining your accounts. I mean, a lot of times you're not able to work, and you have to, you know, take out everything that you saved up this far. But either way, like I said, everybody's report is going to be completely different. So go ahead and fill out the little form down there, and then depending on the state that you're in, the information that you input will just literally kind of scour through all of the because all of the companies have to be vetted by the state. So we'll just look through, all the companies that are successfully vetted, and then just run whatever report is showing the most optimal plans for your specific self, and go through them with you.